Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Great. Well, hello, everyone, and thank you so much for joining us on the Millionaire Next Door podcast. We are thrilled to have you here. We're recording this. It is June 4th of 2025. It's always an interesting time in the markets, but I think especially now we've come off some very deep volatility that's probably not gone away, some April 7th lows, but the markets come all the way back. Paradoxically, a lot of people are still highly concerned about the volatility or not feeling like everything is hunky-dory and perfect and all systems go. Yet the world continues on. So I have a guest today I've brought on. We're going to kind of deepen our discussion on alternative investments, private credit, things like that, how those are positioned, maybe why that's a good solution for some portion of a portfolio in that environment. And my guest today is Mark Gatto. He is with CION Investments. Welcome, Mark. Thanks for being here.
Thank you, Robert. It's good to be here today.
Yeah. So great to have you. And we've been going off on this theme for a while, but it's an interesting time frame where we've come back to, where we are, where we're going forward. I guess despite some of the positive economic backdrop, the first half of the year has seen a lot of uncertainty, leading to increased volatility in public markets. How are the private markets responding?
So the private markets are a little bit different, react a little bit different. Not to say that they're not impacted by what we hear in the news and the volatility that follows within the public markets. But the beauty of the private markets is that when we invest capital on behalf of our investors, we're doing it for the long haul, right? And we're looking to buy and hold these assets. We're investing in what we believe are really strong opportunities with great management teams or in really reliable assets. So we don't get so caught up in the day-to-day volatility. And I think that's where investors can benefit from exposure to these types of assets, is that they're not impacted in such a way or as sensitive to the technical aspects of the broader market. And that's why we advocate for alternatives in a portfolio to really be that mitigator to the everyday volatility that we're seeing in the marketplace. And in the last, certainly recently with everything that's going on, but really over the last 10 years, right, we've seen a ton of volatility. We've seen where investment theses can change overnight. And what we try to do is really offer our investors something that's reliable, consistent, something that they can sort of set it and forget it. And that's where the private markets really, I think, work for investors. And if you look at what we offer at CION Investments, we offer a private credit fund that invests across the entire credit spectrum, but focuses on private credit. We offer infrastructure. We offer a middle market lending vehicle. So we're really focused on what we believe is the heart of the private markets. And we think that these types of assets, whether they're with CION or other managers, can really work well for individual investors today.
Reliable, consistent. Who isn't looking for that in these times, for sure? But hey, before I go too far, I didn't know if you wanted to introduce a little bit or tell a little bit about your firm or your role. I mean, if you're welcome to.
Sure. And I'll clarify a statement made earlier about CION Ares. So CION Ares is one of our partnerships that we have, but I'm the co-CEO and co-founder of CION Investments. And what we are is an open sourced, open architecture, alternative investment managers that provides investment solutions to the wealth channel. And what we try to do is really bring together our expertise in alternatives and servicing the individual investor with the combination of best-in-class asset management. And we've been able to do that through our partnership with Ares Management. As you referred to before, the CION Ares partnership is called CION Ares Management. The fund that we offer through that partnership is CION Ares Diversified Credit. We also have a infrastructure fund that is similarly structured, whereby we partnered with another best-in-class asset manager within the infrastructure space, Grosvenor Capital, and that business is called CION Grosvenor, and we have the CION Grosvenor Infrastructure Fund. And then we also have our own proprietary business. It's a New York Stock Exchange listed business development company that's managed by our internal people, called CION Investment Corp. And that really rounds out our platform of what we believe are three flagship products within the private markets that really provide advisors and their clients with different solutions for different needs within a well-diversified portfolio.
Perfect. Yeah, I've been really going down this road for quite some time and allocating, kind of going deeper into alternative investments. I've found it really productive when well done and balanced for client portfolios for the right types of clients. And there's a lot of need. And a big point of discussion we've had on the podcast is how this area has starting to become much more democratized and available to more retail investors, or it doesn't have to be the Yale Endowment, the Harvard Endowment, the Sovereign Wealth Fund. They're now gaining access through vehicles like yours that they can gain access to through a firm like ours at net asset value, and with some guidance on the way, so they're not going it alone, because I think people need to have a little bit more understanding to know what's going on. But that's been really productive. We've discussed it a lot. Private credit, that's been a very, very attractive area. The infrastructure area, I interviewed one of your peers, I guess, in episode 69, a couple of the portfolio managers. Just listened to it again the other day. All the reasons to go into private infrastructure. And every conference I travel to, it's a really big deal, and how sort of diversifying and lowly correlated, and how it's just a whole different thing than the public markets. And I'm hearing now, as much as 90% of companies in the U.S. making over $100 million are private. Yeah. And most people have very little access to this, especially in their 401ks, and might be their largest asset. But that kind of frames it. But all those thoughts, anything else, what is really driving demand in this space? And love to get your perspective, because these continue to grow, and it's been exciting to witness and give people access to solutions like you provide.
Yeah, so I think you hit the nail on the head at a high level, right? The marketplace is really comprised mostly of private companies today, right? Many years ago, you had thousands of listed companies and maybe hundreds of private companies, and now you have the flip side of that, right? The U.S. middle market alone is the third or fourth largest economy in the world, so it's a very significant marketplace, and it needs a lot of capital to function properly. So that's where private markets, private credit really come into play. And you've seen this explosion of private credit in particular because of the banking regulations after the great financial crisis, typical money center banks really being regulated out of the business, regional banks pretty much the same. So the private lender, the alternative asset manager has really replaced the bank and has been the capital source for private companies within the United States. And it runs the gamut, where if you look at the business maybe, 10, 15 years ago, it was really focused on what we would call the traditional middle market, $25 to $75 million EBITDA. But today, the very large asset managers are doing multi-billion-dollar deals with very large companies that are still private, right, in this marketplace. So that's what you're seeing there. And then when you consider the investing side of the business for investors, the real reason we're seeing this explosion is twofold. One is advisors and their clients are realizing the 60-40 portfolio doesn't really get the job done long term. There's a lot of volatility in the marketplace, and you have to have a strong constitution to really stomach the the volatility that you see in the market. But what really has changed the game is the advent of structures that allow the individual investor to really invest on the same terms and conditions that the institutional client has been investing on for many, many years. So when you think about private markets, private debt, private equity, infrastructure, all these certain asset classes, it was really the domain of very large institutions or ultra high net worth individuals that had been capitalizing on the illiquidity premium that is present in those types of assets, the complexity premium that's present in those types of assets. And those investors typically didn't need liquidity, so they could really drive returns and meet their long-term objectives in a better way than a traditional investor could through traditional assets. So when you look at the landscape today, and we were one of the very first firms in the business to really bring these types of investments to the individual investor. That is the hallmark of our platform of CION Investments. All of our products are accessible for individual investors of all walks of life, from non-accredited to ultra high net worth. We have all those types of investors in our funds. But these structures, the business development company and the interval fund structure in particular, have really opened the gates, if you will, the floodgates, because we're seeing a lot of capital come in. And the reason is that obviously these are registered products. There's a lot of transparency. Individual investors can rely on the regulations behind it, and also the visibility of what's going on through the public filings, which you didn't typically see, or you did not see at all, I should say, in an traditional alternative investment, which were very opaque, had very long lockup, 7 to 10 years, required very high minimum investments, easily 7 figures, sometimes more. So it just wasn't appropriate and attainable for an individual investor. But when you look at the products today, with the transparency, with the what I'll call limited, but I think appropriate liquidity built in to these structures. If you look at the interval fund structure, you have a situation where investors can access their capital on an interval, a periodic basis, a quarterly basis, typically at 5% of the net asset value per quarter, 20% per year. So meaningful liquidity, especially when you consider the types of investments that are being targeted for those types of vehicles. So that liquidity has really been helpful. And then the minimums, right? That's the game changer in the fact that with respect to our funds, investors can get in for as little as $1,000, right? Now, that's not what they typically invest. They typically invest more, but we give access to anybody who has a financial advisor to invest in these types of products to really drive returns and produce alpha within a well-diversified portfolio. So between the structures and the low minimums, the transparency, the liquidity that's available, it's really opened the opportunity for individual investors. We're still in the early innings. There's a lot of growth to come, but we're very optimistic that advisors are really starting to open up to alternatives within the portfolio. I think the education is getting a little bit better. That's one thing that we really pride ourselves on, is to get the proper education out to advisors and their clients so they understand what they're investing in and why it really is something that can, again, help their portfolio and help them achieve their long-term investment objectives.
Yeah, that's really good. And that's exactly what we're doing here through the podcast, through this discussion, as the education piece. It's good to hear that most of these providers sort of come with that big institutional focus, where their clients really are large sovereign wealth funds, Yale Endowment, Stanford Endowment, et cetera, et cetera. You don't have that focus. So that's kind of, and everybody can have access, provided they're working with an advisor who understands all the parameters. And just like you couldn't say every food is good if you're allergic to it, or you don't digest it well, it's not good for you, but it might be good for someone else. So,
right.
Hey, a few questions. This large demand, the dollars piling into certainly private credit, maybe some of the other areas. it does come up. There's been a massive amount. Now it's that market has sustained that just fine, but there have been a few concerns, and maybe people wonder, is it too much, or are you seeing any problem with that or challenges, or is the system set up to process that and you're fine at this point, or just your thoughts around that?
So I think that people have had this talking point for some time about a lot of capital coming into the space and whether or not there's enough opportunity. But as we discussed earlier, the marketplace for private debt, private credit is enormous. It's a multi-trillion-dollar marketplace. And again, when you consider all of the companies that are private in this country and the scale of it, I don't believe that there's too much capital in the system per se. And there's a lot of opportunity for platforms to provide necessary capital to really high quality companies. That's not to say that there isn't competition. That's not to say that there won't be dispersion among managers within the marketplace. But I do think that the market is so big that if you are partnering with the right managers that have the right ability to originate high quality deals, have the capabilities to underwrite those transactions, and also are able to work through situations when they arise, then I still believe it's a very sound place to be within alternatives. It's really, to me, it's really a fundamental position to have in a portfolio that is private credit, because it is so pervasive within the marketplace. So it really comes down to, again, you have to do your diligence. You can't just hand your money over to anyone, right? And I think that's more the issue. I think there's just a lot of participants coming into the space, and you're going to see a separation from the haves and have-nots, so to speak. And not everybody is necessarily qualified to invest the capital into private credit and will do it as well as others. But you're going to see the top performers continue to perform well. You will see some volatility. You will see some defaults tick up a bit, but I don't think you're going to see anything dramatic, right? And that's the point. I think we've been in such a benign market environment for so long. Everybody thinks that things continue to go up and there's never any bad noise around a portfolio, and everybody's touting very strong track records. But a lot of those managers that do that, they have not been through cycles. They haven't been tested. But we're very confident that our investment team, obviously the investment team at Ares, has been around a long time investing capital, and we have been tested. And we feel very good about not only performing in this market, but really taking advantage of the volatility that's going to be present. And we think we can do so in a much more effective way, given our experience and given the structure and given the assets that we target, than perhaps some of our peers and some of our competitors. So again, the marketplace is big. It's big enough. It's just a question of whether or not every person who's touting themselves as a private credit manager can really perform, especially in the marketplace that we're experiencing today.
Yeah, for sure. I mean, we do a ton of diligence to know who really knows and who we'd even admit to our platform. So, hey, a few other kind of follow-up, going deeper down to help people really. This is kind of an evergreen resource thing for clients too. They can listen to this 3 or 6 months down the line if we're ever discussing this. But talk a little bit about, I guess, your process on the diligence side. You mentioned defaults. I'm sure there are occasional defaults, but do you sort of bake in there'll be, hey, this maybe 1% default, and that's just inevitable that we miss something, but the yield and the whole process is set up to overcome that, and that's part of our model? Or just kind of curious. And throwing one other thing, I know they're less liquid, but the valuation and the transparency, I've gotten a couple client questions. It's not valued in the way that the public markets every second of every day, but maybe delve into a little bit.
Sure.
So people understand that. And sorry to throw like 3 or 4 questions into one, but
No, I'll do my best to address all of them. And if I don't, please ask it again. Speaking for our platform, when I say our platform, it's the CION Investment platform, but also the CION Ares partnership when it comes to credit and underwriting credit. first and foremost, I think it's very important to understand that to be successful, you have to have an ability to source the transactions, right? And when it comes to our approach, when it comes to Ares' approach, they're different, but they produce the same results, and that's to see an enormous amount of opportunities and to be highly selective. So the fact that we're able to do that is critical to the success. And if we really focus on the Ares partnership currently, Ares is one of the largest credit managers on the street, right? They are the first or second call from almost every institution out there. So they're seeing everything that is available in the marketplace, and it runs the gamut from very large loans to multiple hundred EBITDA companies to $25 million traditional middle market companies. So we're seeing the market, which is very important. And when it comes to underwriting, having the experience and being involved in this business for a long time, whether that's the PMs at Ares or our franchise. I've been involved in this business for over 20 years. We see a lot and we learn a lot along the way, and we continue to improve upon our process and continue to learn. But ultimately, to answer your question, yes, there is some level of default put into the equation, right? We're going to underwrite every transaction based upon a base case, a high case, a low case, and if interest rates spike, if the economy slows down, how is that going to impact this company, and what's going to be the result? But ultimately, when we look at defaults, the most important stat is really the loss rate, right? Because you can have a default, but what do you do with that default? Are you able to work through it? Are you able to turn it around? Are you able to extract extra return through amendments and things of that nature? And that's really, I think, tells the story. If you look at the Ares platform, their loss rates are really low. It's incredible how well they do in terms of when there is a default, getting in there early and fixing it and coming out ahead, right? And they're able to do that, especially in our fund, the CION Ares Diversified Credit Fund. They're able to do that because, again, they source everything. They do the initial underwrite, they do the structuring, they manage the covenants, the early warning signals, if you will, and they have just a tremendous amount of experience and very strong relationships with the private equity sponsors that are involved in these deals. And these private equity sponsors understand that if they want capital, not only for the company that is being looked at currently, but all their portfolio companies, they need to behave in a certain way and respond when things aren't so rosy. And then that is a hallmark to what Ares does and why they've been so successful, not only in keeping defaults at a very low level, but ultimately having very little loss rate. And that's the key to the game here. Things will happen, right? And that's what I said before earlier about the dispersion. You are going to see dispersion in returns and so forth among different managers because, some managers maybe have a difficult time putting money to work. And that's, again, that's where the issue of a lot of capital coming in is a concern. It's not about the actual amount of the capital coming in. It's about who's that capital going to, right? And who is putting that money out, and what is their experience, and are they able to be selective? And I think that's where you're going to see in a marketplace like this, where you have, again, supply, a lot of capital coming into the marketplace, and then the question is, okay, what about the demand side? Are there companies that are looking for capital, and if that manager can't find the good ones and they put it out to whomever will take it in order to put their capital to work, then you're going to have problems. And I feel very confident that our partner Ares is the best of what they do, and our investors are in really good hands. And ultimately, during these types of environments is where Ares really outperforms the competitors. During the benign environments, they may underperform in some respects because they're more conservative, they're more selective. But really, when you have a situation where there's uncertainty and the economy's not as strong, perhaps, than it was 5 years ago or 10 years ago, whatever time frame you want to look at, you need a manager that really knows what they're doing and can put that money to work in a very prudent fashion.
Yeah, I agree. I agree 100%. Hey, not to put you on the spot, I don't know if you're prepared, but is there an example you can give of, you could say the name of the company, you don't have to, but for, like I'm thinking in private equity, people understand a SpaceX, we're putting up these two a day, every 2 days, he's putting up a rocket to build star. I mean, that kind of thing is not accessible through the public markets. There's another I've heard, like the PG&E wildfire settlement. A large settlement's already been deemed down. There's exposure to that. It's just really diversified away from the public markets. I didn't know if you had any things you're excited or even broad areas. I don't want to put you on the
Well, I
spot if
say
you're
that I would
not.
say
Yeah.
I would say that what we do is pretty boring, right?
Okay.
And that's a good thing, right? We
Yep.
are typically targeting first lien, senior secure loans to what we believe are high quality companies. And if you look at our portfolio, the CION Ares Diversified Credit Portfolio, there's over 700 names in that
Hmm.
portfolio, 700 loans, right? So we run the gamut. And at the end of the day, a lot of the most attractive U.S. private companies are companies that you haven't heard of, right? But we've had everything in our portfolio. We've had Rawlings, the
Hmm.
baseball company. We have some of the professional international soccer teams. Barcelona, I think some maybe a team from the Premier League. I think the Miami Dolphins are in the portfolio. If you just want to talk about those types of companies, but ultimately they're really sort of under the radar screen companies that really fuel the economy, and that's what's important, right? We're not trying to be flashy and sexy and target things that people want to say they that's a good name and that's kind of interesting. We just want to be boring, right? We don't want you to have to like think about what we're doing, because ultimately if there isn't any noise around what we're doing, then we're doing our job, right? So I think from that said, you can certainly think about it in terms of what makes the economy go is what we invest in, and that's why it's such a good performing, consistent investment opportunity for clients. We've been in the business for almost 8 years now, right? We've been doing our interval fund for 8 years. We're one of the first out there, and all we've been able to do is deliver consistent dividends and low defaults, and that's what we're trying to do every step of the way.
No, that's really good. And there's a lot of people, myself included, kind of unexciting and boring and plain vanilla, and you never hear about it because it's not sexy. And that's, maybe what they're looking for. But that helped. Everybody I certainly had a Rawlings glove. It took me back to 15 years old, sitting out there relying on that thing to stop the
Yeah.
ball. And we're being presented with these there's now specific these types of alternatives that are just in the sports space that feels a little deep in that, but I'm getting all these updates of all the stuff going on, whether it's in the NBA or Manchester United.
Right.
So it's really interesting to hear that you've got some of that in, and most people don't. But that is a big area that really high net worth and institutional may go in. There's certain sports franchises with,
Right.
I mean, we're in LA, the Dodgers and Otani, just the jersey sales. If you go to, it's just unbelievable how it's, or just the Japanese folks that have come in or all around the world. It just the sales, regardless of whether he gets a hit or not. So it's baked into that.
Yeah.
But let me see, we're going to start to kind of land the plane here, but this has been really, really helpful. Didn't know if you wanted to like summarize any of this. I mean, kind of thinking how private markets, we've already covered it, but help investors achieve their goals, how they fit into traditional understanding of stock and bond portfolio. Maybe summarize, and any other thoughts. Sort of, I know you have a very relatively attractive yield on the portfolio. That may be something people want to know about.
Sure.
But go ahead and yeah.
Yeah, so I think just to answer the last question regarding our yield, it's been fairly consistent, as I said before. What we do is, I would argue, very conservative in many respects, and that's the approach that Ares takes. And if you look at the portfolio, it's very highly diversified, which we think is very important. And our strategy allows us to be nimble, to really move in and out of different areas of or asset classes within credit to address the volatility that's in the marketplace. And that was something very important for us when we were designing this product, is that we recognize that there's a lot of volatility in the system. and investment theses are very quick to change, and to be really long anything doesn't make sense in this environment. So the CION Ares Diversified Credit Fund, it's diversified, that's in the name, and that's important to us, but it's also dynamic, and it's able to allocate capital to where the best relative value is at any given time within the credit space. And having a partner like Ares that has an enormous amount of experience and deep capabilities really enables us to provide that dividend yield that we've been performing with over the years. I think in summary, it's just really important for advisors and clients to understand that alternatives are important, right? And again, early days, if you think about it, I think less than 50% of advisors actually use alternatives currently, right? An alternative allocation in a typical individual investor's portfolio is less than 5%. They tick a lot of the boxes. They give them some control over their capital, and yet they're delivering the types of returns that really outperform the traditional fixed income assets for sure. And if you think about where the equity markets are today, I don't think anybody's going to tell you that they're going to consistently return more than 10%. So if you think about a private credit fund or a diversified credit fund that can deliver returns without the volatility in a more conservative structure, that that's pretty compelling. So everybody has to look at it. So I think that's sort of important, is that advisors need to look at these for their clients. Their clients need to become aware of what's out there and what's appropriate for them. And that dovetails to education, right? And that's going to be really important. Advisors need to be educated, clients need to be educated, and that's our job, I believe, right? Our job is to really work with our partner advisors and provide them with the education, be a solutions provider. Because I think one of the challenges for financial advisors in this market is that there are going to be more and more opportunities. There's going to be more and more products coming their way. And how do they sift through all these products? How do they have the time and energy and resources to, meet with all of these managers, do the diligence, do the underwriting? And it's critical that they partner with platforms that can provide multiple solutions to them to streamline that process and give them the type of education that they're going to need and their clients are going to need to make an informed decision. And I think that's the approach we're taking at CION, is we want to be that partner with the financial advisor community where we can offer different solutions, and in our case, through different high quality managers, so that you're not always putting your client in the same manager in different investment strategies, right? With us, you have sort of a multi-brand platform that allows you to work with us but not have too much exposure to any one manager. And that's what we're trying to achieve. Again, we want to be at the forefront of education because we really think it's important. I think historically, a lot of the problems with alternatives, or even early days with the alternatives for the private wealth channel, was that they weren't being sold correctly. There was a lot of misinformation around it. And those things are changing. And again, we want to be at the forefront because ultimately, we're in this for the long haul. The individual investor is our number one priority, our client, and we need to provide the information and high quality product opportunities for them to be successful, and then in turn for us to be successful.
That's really good. That's a really good summary. And for a lot of folks, that's a pretty good value proposition in the right context, given the uncertainty, given that policy decisions are made, big ones that might be dependent upon whether someone woke up on one side of the bed or the other, on a daily or weekly basis. It's just an interesting time. And maybe equity valuations are not cheap at this. They're certainly not inexpensive at this point, but
Right.
That is super helpful. I really appreciate you coming on. I value that partnership too, that there's different managers we can use with different credits, but really fundamentally sound processes of what goes in if we're going to allocate folks' real capital to them. So this has been tremendously helpful from that education standpoint. And I hope the listeners get something out of this. Feel free to ask me any questions, Anything I should have brought up or asked you, or anything you're dying to share? Have we
I
covered
think
it all for now? Yeah.
I think we covered it, and
Okay.
obviously we can do this again if you get more questions and your clients and your listeners need more information. We're happy to come back and do it again.
Really appreciate it, Mark. This was terrific. Again, this is an evergreen resource combined with the others. I know your team at CION actually listened to or a bunch of my prior podcasts to see what I've covered, how this might fit in that context. And so I think this is, for folks who are listening and paying attention, going to be a really valuable resource. And so please like it, share it. Let me know if you have questions. Really appreciate you being here on the Millionaire Next Door podcast. Make it a great day.
Absolutely. Wonderful to be here.
Yep.
Thanks, Robert.
Thanks, Mark.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.